Hello everyone and welcome to the second session of our inaugural MSc Financial Analysis and Fund Management Alumni Conference on the theme of ESG and sustainable investing. Thanks to everyone who's joined us today, and thank you to everyone who joined us yesterday as well for our industry partner session. Great to see so many of you. Today is our alumni session, so you'll be hearing from our keynote speaker Christian Wilson, who I'll introduce in a second, and then also from 1:20 onwards you'll be hearing from our MSc FAFM alumni ambassadors and myself on alumni community activities and alumni benefits all around the world. So I'm delighted now to introduce our main keynote speaker today, Christian Wilson. Christian graduated from Exeter in 2016 with a BA in economics and a MSc in financial analysis and fund management. Now, alongside working on his PhD at Oxford, he also has a role as a green finance policy advisor at the UK Government Department for Business, Energy and Industrial Strategy. Without further ado, I'll hand over to Christian now, and please be aware that you can put your questions to Christian during his presentation into the Zoom chat, and afterwards I'll be posing them to Christian in a Q&A session. Christian, over to you.
Fantastic, thank you, Josh, and good afternoon everyone. Thank you for having me. Just so very quickly, I'm kind of speaking today with my Oxford hat on. We'll briefly talk about stuff that the UK is doing, but it's, I can speak more freely and we can talk about more interesting stuff, speaking with an Oxford hat rather than a Bayes hat. And apologies for not having the screen properly shared. I had slight IT issues, so suboptimal. Thank you for bearing with. So today we'll talk about cost of capital and the low carbon transition. I'm going to structure the talk as follows. First of all, we're going to talk about why the cost of capital matters for low carbon energy in particular, and then look at what action has been taken by UK policymakers to help influence that. And then I'm going to talk about some research I've been doing at Oxford, which kind of docks into the point, and it's about how the rise of passive investing can influence the pricing of climate risk, either in a positive or a negative way. And then very happy to open questions. There's quite a lot of slides, so if we don't get through it all, I can skip through the last few as they're less critical. But we'll try and move at a relatively fast pace, as I know we've got a lot of finance students on the call. I'm sure you're probably more clued up on some of this stuff than I am. Very brief introduction to me. As Josh mentioned, started at Exeter, where I did BA Economics and then the Masters that some of you are doing now, as well as doing my CFA exams. And then I started in asset management for a few years, working in emerging market debt, which was really, really interesting. I started to get interested in climate change, how that connected with my day job of working in asset management and investing. And that led me to move out of the industry and to a charity or an NGO called Share Action, where we worked with investors to lobby companies to become more sustainable. So sort of an activist hedge fund, if you will, but as a charity. So a slightly weird entity, but quite a fun place to work. And then this year, well, last year now, I left to join the UK Gov, working as a policy advisor in this area. And they were very kind to allow me to do some research at the same time and start a PhD at Oxford alongside that. So that's me, and happy to answer any questions on background at the end as well. So the cost of capital and the energy transition. Well, first of all, what is the energy transition, and how big are we talking? What do we actually need to tackle global warming and limit temperature rises within a safe limit, which is what the UN IPCC tells us is 1.5 degrees. And so in figure one, we've got a couple of high-level stats on the extent of the change that is needed to limit global warming within safe levels. And so just picking out a few, a random here, coal energy use needs to drop by approximately 100% by 2050, gas between 60% and around 6%, and the renewable share of electricity within the energy mix needs to rise by approximately 70 to 90% by 2050. And significant action needs to be taken in the next 10 years as well. So if we want to limit global warming within safe limits, we need a green industrial revolution. We need to completely change the way our energy system and the economy at large operates. And to do that will require a huge amount of investment and a huge amount of capital. And a proportion of that can be done by governments, but also how can we mobilize private capital and financial markets to help deliver on those objectives. And in figure 2, we briefly look at the investment gap, so what we're currently missing in terms of the investment we need to limit global warming again to 1.5 degrees in line with the IPCC recommendations, but also even just to meet the NDCs of the moment. So the policies that countries have put in place and the commitments they've made right now to deliver on those, we're still short in terms of the investment we need to meet those objectives. So quite a stark picture of the amount of investment we need to level up, not just to 2050, but within the next decade as well. And so this really is the decade of delivery in terms of climate change. And that makes finance critical. And the subjects that you've been studying in your course really, really important. And I think it's not something people always think about when they think about climate change. But actually, if you want to transform the way the economy works and you want to finance lots of new infrastructure to do that, you're going to need finance to support that. And I think this fantastic study that was released last year by the Committee on Climate Change, who advise BEIS and the government more broadly on how to reach net zero by 2050, net zero carbon emissions by 2050. This report really outlines this very, very clearly. And so if we look on the left-hand panel of figure 1, we see above zero the huge amount of investment that's needed within the next 10 years. So a real front loading of investment. And that's across the economy, so not just in the energy sector, but in buildings, heavy industry as well, across the piece really. But what's interesting here is that the type of projects we're going to be investing in are very CapEx heavy, but with less OpEx. So that means if you're investing in low carbon energy, it's more expensive up front in terms of life cycle costs, but over the whole life cycle of that project, the operating costs are lower because energy is cheaper, infrastructure is more energy efficient. And therefore we're moving from an OpEx towards away from an OpEx-based economy towards a CapEx-based economy when we're thinking about this investment that is required. And if we're financing this CapEx up front, that makes the cost of capital, so the price at which we can do that, very, very critical. And the CCC draw this out very nicely on the panel on the right. So an increase in the cost of debt from 1.5% to 7.5% can approximately increase the overall costs of reaching net zero by around 30%. So that's irrespective of scientific breakthroughs, all the other things that we need to happen to reach net zero. The fundamental fact of the matter is that we need cheap financing and patient capital to do that. And so that makes financial markets really, really important. And so if we're thinking about the cost of capital as a way of making that transition cheaper, we need to think about what is influencing the cost of capital at the moment. So what is going to make the transition cheaper for certain entities and what is going to make it more expensive for other entities? And at the moment, a huge part of sort of the discourse and the discussion, both within practitioners in the sustainable finance space, but also with policymakers, is about how we can provide the market with the information that they need to price climate risks. And climate risks are the risks that are going to emerge through this transition to a low carbon economy. And I've just highlighted a few of these different types of risk here. So you've got policy risk, for example, carbon pricing. You've got technology risk. So for example, if you're a fossil fuel company and renewables are undercutting your business, that's a technology risk. And then finally, you have a legal risk. So we're seeing a huge amount of lawsuits being brought against fossil fuel companies and carbon intensive companies regarding their activities and the impact that has on climate change. So because of these transition risks, we would expect the cost of capital to start to reflect this. And if the cost of capital is reflecting climate related risks, that can make it easier for low carbon technologies to advance because they have less of these climate risks. And it should make it harder for carbon intensive and fossil fuel industries to grow and expand because these risks are priced into the cost of capital. At least that's the theory. And this theory of change is sort of outlined here with this relatively simple infographic. So as you all know from kind of your studies, lots of things go into the cost of capital or your discount rate when you're thinking about a company or a project. And within that, climate-related risks sit. And so if those risks are priced, that should be reflected in the cost of capital. And that should therefore influence the internal capital market decisions that are made by companies. In other words, if the cost of capital for one project is much higher than the other, that should influence the decisions that they make when they make those internal capital allocation decisions. So for example, using a net present value model or your internal rate of return, these are all methods which are influenced by the cost of capital. And therefore, if climate risk plays a part in that, that should enable the low carbon transition. And this slide explores that thinking a little bit further. And so if you think about two different types of cost of capital, you've got the right-hand side of your company balance sheet. So the weighted average cost of capital, which is the rate at which, as I'm sure many of you know, your equity holders and your debt holders will be willing to kind of provide you with capital. And so the market determines the WACC, not the company. However, it is the company that determines the cost of capital that they use when evaluating projects that they want to invest in. So we're kind of trying to connect here financial markets and corporate finance. So corporate finance, it's the company that will decide how they discount cash flows to evaluate which projects they want to invest in. And those two different types of cost of capital, the one decided by the market and the one decided by companies, are not always the same. And so there's quite an interesting dynamic here, which is if climate risks are priced in the cost of capital, to what extent will that influence the decisions of companies? And that really depends on the extent to which the WACC feeds through to the hurdle rate that companies use to make those internal investment decisions. And it's the hurdle rate that will be used in your sort of internal rate of return valuation models. I'm sure some of you have learned about in your course. Likewise, for MPV, it's the discount rate that companies will decide on. Now, in theory, these companies should be using either a project-specific cost of capital, but often what we see is they actually just use the WACC. And so a variety of surveys and pieces of academic research show that often companies will just use the WACC that is determined by the market as their internal cost of capital. So they won't actually necessarily adjust for the different types of project risk. And that makes the cost of capital really important when we think about how the market prices climate risk. In other words, what markets think about climate risk can feed through directly into corporate investment decisions. And this is quite interesting in a number of different carbon technologies. The first of which is electric utilities. So for example, when we turn on the lights in our room, it's electric utilities that provide the electricity for that. And at the moment, there's this kind of battle between renewables, which are rapidly eating into market share, and sort of incumbent technologies such as coal and gas. But what's really interesting here, if you think about the slide we looked at the start around the shift from an OPEX or operating cost-based economy to a CapEx-based economy, these two different types of technologies have very different profiles in terms of those costs. So renewables have very low ongoing costs, high upfront costs, and that's the opposite for fossil fuel technologies. And therefore, that means for fossil fuel technologies such as coal and gas, the proportion of costs that are sensitive to the cost of capital are much, much lower. And that's because in terms of the life cycle costs, as we see in figure 1, those variable costs count for a smaller proportion of the life cycle costs. Whereas if we look at wind and solar, those upfront investment costs account for a much larger proportion of life cycle costs. And that means they're much more sensitive to changes in the cost of capital. And this can be a really good thing if cost of capital is low, because it makes renewables cheaper. But if cost of capital rises, this could disadvantage renewable technologies relative to fossil fuel technologies. And if you think about where interest rates are at the moment, central bank rates, they're at record lows on kind of a long time scale. And that's been a contributing factor in helping drive down the cost of renewables. And if that was to reverse, for example, with COVID, fiscal stimulus, and other economic growth that we would expect after we emerge from the COVID-19 crisis, that could actually reverse that trend somewhat because renewables are much more sensitive to the cost of capital. And that sensitivity is shown quite nicely in figure 2 of this slide. So we're comparing gas, which is the highest proportion of variable costs and the lowest proportion of fixed costs, to wind, which has a much higher proportion of fixed costs relative to variable costs. And we see that as the WACC decreases, wind becomes cheaper than gas, but as the WACC increases, gas becomes cheaper than wind, and that's on a levelized electricity cost basis. So a really interesting dynamic here. So if we see these climate risks being priced, that should help lower the cost of capital for renewables and make them more competitive relative to fossil fuels. And the other key sector, hang on, I might just miss the slide. Yeah, no, I haven't. And actually, we are starting to see this play out in practice. So this is some work done by my colleagues at Oxford that I've been working on as well. And we see that in the electric utility sector, we are seeing a shift in the cost of capital. So in the aggregate, although the change has been not that big over the past decade, as shown by figure 1, if we actually look within those sectors at technology-specific cost of capital, we do see divergence. And if we look at figure 2, we see that for coal power, there's been a significant increase over the past 10 years, 83%. But for gas and oil, no real increase, which is very interesting. If we look at renewables, there have been drops in the cost of capital. So offshore wind, the cost of capital fell 34%, solar down 19%. So we're starting to see the most carbon intensive technologies such as coal increase, renewables decrease, but those fossil fuels which are not as carbon intensive as coal, so gas and oil, we're seeing less movement in those areas. And so investors may not be pricing in those transition risks, those climate risks to the same extent in those technologies. Similarly, we can think about oil and gas and fossil fuel extraction, which is the other key sector where we're seeing climate risks play a really important role. And if we think about different types of oil and gas projects, you have these huge mega projects with long life cycles, and they tend to harvest cash flows towards the back end of their life. And then we also have sort of shale projects, which are shorter in life and harvest cash flows much, much quicker. And some research done by et al. At Oxford, I've kind of thought about this dynamic and what happens if the cost of capital changes. And if the cost of capital was to rise for oil and gas, we would expect to see oil and gas companies move away from those mega projects where cash flow in the future, and therefore we would discount them at a higher rate and be less valuable. And instead, oil and gas companies will move towards shorter life projects with a lower risk that provide cash flows earlier on. And if that behavior was to emerge, we could see a restriction in the expansion of oil and gas, which for low carbon transition could be good. So to what extent has this actually played out in practice? Again, this research that I referenced earlier, not so much. We haven't really seen the same shifts in oil and gas that we've seen in coal. So again, if you look at figure 1 on the left, the cost of capital for coal mining, so the extraction of coal rather than the burning of coal for electricity, has increased 54% in the past decade. Oil and gas has been relatively stable. So again, are investors pricing in climate risk in those more carbon intensive sectors like coal, but less so in oil and gas, which I think is an interesting observation. So what are UK policymakers doing to help facilitate the pricing of climate risk in the cost of capital? Well, the first thing is that in November last year, the government announced that they will mandate climate-related risk disclosures. Companies in the real economy, investors in the financial sector, and asset owners such as pension funds will by law be required to disclose the climate risk of their operations or their investments. And this sort of infographic tries to give a flavour of what that will look like, but it will be based around 4 key pillars. So governance, what are companies doing in terms of the ownership of climate risks? Are senior leadership taking ownership? What is their strategy for reducing climate risks? What is the risk for reducing it? And what metrics and targets are companies setting? So for example, are they going to cut their carbon emissions to 0 by 2050 in line with the UK's target? And the hope is that if you provide financial markets with this information about climate risk, it will make it much easier for them to price this into the cost of capital that can facilitate capital flows towards low carbon and away from high carbon, and also reduce systemic financial risk as well. The second kind of strand of this is the development of a green taxonomy. And this kind of drills down into the metrics and targets aspect of TCFD. And what the taxonomy will be is a framework that defines what low carbon looks like. So for every carbon intensive or almost every carbon intensive activity within the economy, the taxonomy will define what is low carbon. And companies will be required to disclose their alignments with that definition. And the objective of that is that you tackle greenwashing, because companies will be uniformly required to disclose how green they are, but also you give certainty to investors that want to finance low carbon. So if you think about the huge growth in ESG investing that we're seeing at the moment, if we give that transparency and that certainty to investors about what low carbon looks like, the hope is that that will facilitate low carbon capital flows. And there are a number of other sort of policies that can be built off this taxonomy once it is in place. And then the other strand of policy making that was announced in November as well was the establishment of a national infrastructure bank. And one of the things this bank will be doing alongside other operations and projects is helping the private sector to invest in low carbon technologies. This is often done through blended finance. So for example, if you're having a first of its kind infrastructure project built in hydrogen, for example, where risks are really, really high, investors may be wary of engaging in that project. But if we have the National Infrastructure Bank coming in as well and investing alongside and providing blended finance, that can help reduce risk for the private sector and reduce the cost of capital for the company looking to raise money. So those are kind of three strands that were announced in November by the UK that my team of Bays is working on alongside other departments in the UK Gov. So that's kind of part one. I'm just going to very quickly check when this presentation is to wrap up. Don't overrun too much. Let me just check. No, we have enough time. Perfect. Yeah, so the second part of this talk is kind of reflecting on the second part and thinking about the current structure of the financial system and whether it lends itself to the pricing of climate risk. So we've outlined that the cost of capital is really important for reducing the costs of reaching net zero. We've shown this can change the economics of renewable versus high carbon projects. And we've shown that we're already starting to see a change in the cost of capital in the market. And to support this, UK policymakers and other policymakers across the world are putting in frameworks to provide the market with information. But my concern, and this is part of the research that I'm set to do in Oxford, is to what extent is that information actually going to be used by participants in the market? If the market is starting to become dominated by passive investors, which by definition don't price risk, is that not going to restrict the effectiveness of these policies? So first of all, as I'm sure many of you are aware of, passive investors sort of the growing power within the investment industry and asset management more broadly. And of course, passive investing is when you follow a fixed index. You don't try and beat the benchmark, you try and match the benchmark. And this market is really dominated by what's known as the big three, so BlackRock, Vanguard, and State Street. And the concentration of the passive industry and the rapid growth of passive investing more broadly are driven by very much the same factors. And those are one, economies of scale, two, liquidity, and three, innovation. And if you think about ETFs and passive products, what they do is ultimately relatively straightforward. You're just trying to track the index. And that means when you set up an ETF for the first time, there are certain fixed costs that you need to cover. You need to pay for your portfolio manager, legal fees, marketing, and all the rest of it. But once those fixed fees are covered, the economies of scale are somewhat infinite. So for example, if your ETF grows from 1 billion to 100 billion, your fixed costs are not going to grow by a factor of 100 whatsoever. So the larger the ETFs become, the more they can drive down costs and the more cost competitive they are. And that really drives the largest ETFs to become even larger. The second of all is liquidity. Once exchange traded funds are very large, people like to invest in them because they're the most liquid. That makes them even larger. And so you've got these positive network effects, which really drive the concentration that we see in the industry. And third of all is innovation. So it's very easy for a BlackRock or a State Street or a Vanguard to replicate a new ETF that comes to market. So if you're a challenger firm, one of these companies, incumbent companies, can look at what you're doing and replicate that themselves relatively easily. And therefore their status in what is essentially a oligopoly is quite hard to challenge. And this has resulted in passive investing on the equity side accounting for around 50% of AUM, assets under management at present, and around 30% in fixed income. So a huge proportion of the investment industry is passive. And I think this chart nicely illustrates this concentration that we see. So on the active side, on the left-hand side, the top 10 players control around 25% of the market. For exchange-traded funds, the top 3 players control over 75% of the market. So the rules of the game are completely different to active management. And that's why we see this huge concentration. And what we're seeing because of this is a huge amount of power concentrated in the hands of a very few companies. And this can have a number of implications. One is on investor stewardship, and that means corporate governance. So if you're an investor and you own a big chunk in a company, you have a role as a steward to ensure that company not only provides profits for you as a shareholder, but also has societal impact, does not contribute to climate change and all these other societal objectives. As a steward, an owner and a shareholder, that is your responsibility. And if we extrapolate forward this growth in passive investing from the present to around 2040, these 3 companies could control over 30% of every company in the S&P 500 on average. And that is a huge amount of power. And the reason that's concerning is that these companies have a terrible track record when it comes to voting for climate shareholder resolutions. In other words, they are not using their power to push for climate action. We're starting to see this change, and that's great to see, but historically, their track record is poor. And so if we're seeing the asset management industry and power concentrated in the hands of these few investors, whose record on climate change is to be questioned, is that an issue for the effectiveness of financial markets in contributing to the mitigation of climate? And the second implication is on capital flows and the cost of capital. And if you think about this infographic we looked at before around why the cost of capital can influence the corporate investment decisions of the real economy, if we have 50% of the market not pricing risk at all, would that not jeopardize the effectiveness of the policies that we are putting in place to give the markets the information that they need? So that's one thing. The second thing is on the cost of capital as well, from a capital flows perspective. And existing research and literature shows that the larger the proportion of passive demand, the lower the cost of capital, and the easier it is for companies to issue debt. So if you're a company in an index, a fossil fuel company, for example, it's very easy, or it's easier for you to issue bonds and finance your projects if you're in an index and tracked by that index. And so we could end up with a situation where passive products become financiers of last resort as active investors step back from fossil fuels. And we're seeing there are vast divestment commitments in the market. At the moment, around 15 trillion have committed to divest from fossil fuels. Another 15 trillion or so have pledged net zero portfolios by 2050. Even if those commitments are implemented, if we have ETFs and passive products which automatically underwrite fossil fuel finance, the effectiveness of those commitments could be limited. And there is a lot of growth in ESG ETFs, and that is a great development, but at the moment they represent a very small proportion of the market, and that's what we see in figure 2. On the fixed income side, about 11% of ETFs are ESG themed, so environmental, social, and governance, but around 0.1% of AUM is in those funds. And that's because of those network effects we spoke about before. Big ETFs stay big because they have low fees, high liquidity. And so to examine the role of ETFs, we need to think about primary markets rather than secondary markets. Because primary markets are where new securities are issued and capital is exchanged from the financial system to the real economy. Now, this is different to secondary markets. So a secondary market transaction would be portfolio manager A selling a bond or a share to portfolio manager B. No capital is given to the actual company who has issued that share or bond within that transaction. In a primary market trade, capital directly goes to the company and a security is given to the investors. And so if we want to examine the role of passive investing, we need to focus on primary markets especially. And what we see here is that in primary markets, fixed income and bank loans are critical. And equity is less than 10% of financing. So although the equity markets are very important from a shareholder stewardship perspective, in terms of financing carbon intensive sectors, it is bonds and it is loans that are absolutely critical. And due to this, what we've done is some research looking at the trades of ETFs in the fixed income market. And I'm going to try and explain this in a way that's clear. So what we've done is we've looked at all the trades of ETFs over the past 5 years. We've then looked at where those ETFs trades match up with primary market issuance. So for example, if BP was to issue a bond on the 20th of December and ETFs partake or include that bond in their portfolio on the 20th of December, we would see that as a primary market transaction. And what we've done in figure 2 is plotted when those transactions occur. So you see for ETFs, a huge proportion of transactions in new bonds occur on day 0, so on the day of issuance, or on day 1, so the day after issuance occurs. And what that tells us is that even though these ETFs follow indexes, which rebalance every month, they actively partake in primary markets. So they're making active investment decisions, even though they follow an index which does not. And this kind of goes against the grain of what we think about when we talk about passive investing. So these investment vehicles are making active decisions to partake in primary market issuances, even when the indexes do not. And so what we can do is quantify this. So in a very simple metric, we can look at the proportion of primary market trades that ETFs partake in out of all of the trades they partake in. So how many of those trades are in carbon intensive sectors and how many of those trades are in other sectors. And we call that primary market carbon exposure. And approximately 14% of all primary market trades that these ETFs partake in are in carbon intensive sectors. So not only are ETFs making active decisions, but also making active decisions to finance the most carbon intensive companies. And this really depends on the type of credit rating of these ETFs, and digging down into some of more of the detail here. And this really depends on whether we're talking about the investment grade ETFs, so in the safer corporate bonds, or in the more risky ETFs, so the high yield corporate bonds. And if you look at figure 1, what we see is that high yield ETFs allocate a much larger proportion of their primary market financing to carbon intensive companies. And we can split that out by sector. So we see in the high yield space, a much larger share of financing goes to upstream oil and gas. So upstream oil and gas are those companies who actually extract fossil fuels out of the ground. So if you're an asset owner and you're concerned about climate risk and climate impact, and you're buying a high yield ETF, a significant proportion of the primary transactions that your investment are making are in fossil fuel extraction. And what's interesting here is we see ETFs account for ETFs allocate a larger share of primary markets to carbon intensive sectors than the aggregate market. So if you look at figure 1, we see that high yield US bond issuance, the market is lower than US high yield ETF primary market trades. So in other words, ETFs are allocating a larger proportion of their primary market trades to carbon intensive sectors than the market as a whole. So we need to think about why that could be the case. And that's kind of what figure 2 starts to look at. And we see that ETFs account for a larger share of demand in high yield sectors relative to investment grade sectors. And what that tells us is that in riskier carbon intensive sectors, ETFs are accounting for a larger share of demand. And if we think back to our original hypothesis, this kind of makes sense. We're expecting active managers to price climate risk into their investment decisions. And maybe what we're seeing here is that as active managers reduce their holdings in carbon intensive sectors, ETFs are stepping in and filling that void. If the riskiest carbon intensive industries, ETFs could be stepping in and replacing active managers that don't want to invest because of climate risk. And this could have a number of implications for policymakers. First and foremost, the effectiveness of policies that give the market climate-related disclosures could be less effective. ETFs are not pricing or unlikely to price this climate risk in the same way that active managers will. And that could not only reduce the cost of capital, but lead to more financing in carbon-intensive sectors. But also, we need to think about ETFs that central banks themselves are investing in. And for the first time in 2020, in response to COVID-19, the Federal Reserve became, to my knowledge, the first central bank to invest in a corporate bond ETF. And that resulted in a huge growth in the AUM of these products. And you see that on figure 1 on the left. So in 2020, there was a huge growth in AUM when the Federal Reserve announced it would invest in corporate bond ETFs. And in figure 2, we actually break down the ETFs that the Federal Reserve invested in. And we can look at the proportion that was in upstream oil and gas versus downstream oil and gas, coal mining and other sectors. And so I've left on the screen here a few sort of questions to go away with on this topic, which is one, and we've already spoken about this, could ETFs and passive investing become financiers of last resort? Will this reduce the effectiveness of policies to facilitate the pricing of climate risk? And the last one is, how can we actually harness passive investing to accelerate the low carbon transition rather than hinder it? And I don't know the answer to that, but it's something that is really interesting, I think, and something that academics and policymakers and practitioners need to think about further. So to sum up, to begin with, we looked at why the cost of capital is critical for lowering economy-wide decarbonisation costs. But not just in the energy sector, but in the real estate sector and in heavy industry. Reducing that cost of capital is going to be crucial for lowering the costs of reaching net zero by 2050 in accordance with the UK's legally binding target. Recent trends show that we are starting to see divergence in the cost of capital between low carbon and high carbon. But we haven't seen that trend emerge to the same extent in oil and gas. We're seeing it in coal, but not so much in oil and gas. Third, policymakers are taking action to facilitate the pricing of climate risk, for example, through TCFD, through the Taxonomy, and the National Infrastructure Bank, which could also play a role. But finally, the structure of the market and the way the market is trending, which is towards an asset management sector more dominated by passive, could jeopardize the effectiveness of those policies, because the incumbent ETFs, the largest ETFs, are not ESG ETFs. They invest in fossil fuels, and they are likely to do so irrespective of climate risk. And so there's an outstanding question about how the effectiveness of those policies and the divestment commitments and pledges of asset managers that care about climate change could be undermined. And that's all. So hopefully that made some sense. Very happy to answer any questions. And there was a lot of content, so I apologise if any of that didn't make sense. And happy to go back and further explain anything as is helpful.
Thank you very much, Christian. We are going to jump straight into the Q&A session, and I see that there's quite a few in the chat. So first question for you, Christian, from Will Hollis. What are the least conventional data sources you've been using in your research?
So I would say one is this ETFs holdings database we have constructed for this research itself. We had to do that ourselves. So that was me manually sitting in front of a Bloomberg terminal for around 40 hours or so and just joining together all these different data sets. So we think that provides us with quite a novel data set that gives us a level of granularity that's relatively new. But portfolio holdings is not that novel. It's just kind of a nice data set that we had to do that. What other people within our research group have been doing, I'm looking to do in the future, is use a data set called WEP, and that's the World Electric Power Plant Database. And what that tells you is the energy mix of individual companies over time. So, for example, we could take large electric utilities companies and track over the past 15 years the percentage of their energy mix that has gone from fossil fuels towards renewables. And that's a really useful database that a number of researchers have been using recently to put out some really interesting papers. And is great for kind of tracking that low carbon transition in real time on the ground. So it's an interesting database that can be used as well.
Thank you, Christian. Next question, we'll go straight in. Lin Yang asks, how are climate-related risks quantified?
Great question. And I think this is kind of a key motivation for the work on the taxonomy, because at the moment, a lot of companies quantify their climate risks in completely different ways. And one of the key methodologies at the moment is scenario and analysis. So what a corporate will do is say, we are going to use a scenario or a pathway where the economy reaches 1.5 degrees by 2050 or net zero emissions by 2050. And they will do scenario analysis to try and model how their business will respond to that. And as part of the TCFD work that the UK and other countries are looking to implement, scenario analysis is one of the key recommendations there to get companies to try and quantify those climate risks. The issue there is there are lots of different ways you can do that. And so the findings that are then presented to investors may differ depending on the methods used. So that's definitely an outstanding question on how comparable that information is. And so the taxonomy, although it's not as detailed as scenario analysis, the rationale behind the taxonomy is that in each sector, so for example, cement, energy, you will define a metric that all corporates in that sector will use to disclose their environmental performance. So for example, in electricity, companies would be required to disclose their carbon intensity of their operations in the same way. And that means from an investor perspective, if you're trying to compare company A to company B, the metrics to do that will be the same. And that should facilitate the comparison of climate risk. But this is definitely one of the areas where a lot of work is needed to make sure the information is useful for investors. And it's definitely an outstanding issue that hasn't been resolved yet.
Okay. Another question, so this time from Tom Lawrence. He says, fascinating points on relative carbon intensity of passive versus active and importance of primary markets as opposed to secondary. Is the implication of your analysis on ETFs that carbon intensive industries have more volatile prices that can be traded on for short-term gains, while less carbon intensive offer higher long-term yields?
I don't think that's necessarily the conclusion. But I think you kind of raise a broader point here, which is that if you've got fossil fuel industries, and I think actually this does feed into what you're asking about, well, actually, is you are seeing, especially in the high yield space, where the energy sector is more of a larger player, that naturally accounts for a larger share of those high yield indices. So if you think about at the moment, interest rates are at record lows. If you're an investor or a pension fund or an insurer and you need to hit a return target, for example, and you need to get that yield from somewhere. So I think to your point, if you're kind of a yield starved investor and these higher risk carbon intensive companies are offering that yield, that's going to be potentially quite hard to turn down. So I think you're absolutely right. You do have that trade-off between short-term returns and those kind of more attractive yields and kind of the longer-term risk that you have. And that is different to renewables, where returns are likely to be potentially lower, but more stable in the long run. So I think that is definitely a challenge. And I think what we would hope, what kind of needs to happen, is investors need to kind of change their mindset somewhat. And this is somewhat constrained because of the way the investment industry works. In other words, fund managers, for the people I used to work for when I worked in asset management, we were judged on our performance on a quarterly basis. So we would go to our clients and say we under or outperformed the market in this quarter. And that's how our homework was marked, in effect. And if that's how your homework is marked, those high yields in carbon intensive industries are going to be more attractive, right? Because you can outperform your benchmark. And so there's an outstanding question here about how the incentives for the investment industry and how that can be tackled, kind of align the incentives with what we need to happen, which is more investment in low carbon. So that's one point. The other point, kind of building on that, is there's a really interesting theory that someone I used to work with at Cambridge University has been working on, called universal ownership theory. And I highly recommend having a look at that. And what universal ownership theory says is that you're absolutely right. In the short term, you can maximize returns from investing in carbon intensive industries potentially because of those high yields. But in the long term, the implications of doing so are going to be higher climate risk. So although in the short term, for an individual, you may be able to get more return, in the long run, the climate risks are going to increase. And so if you're a universal owner, such as a pension fund, you're going to own a wide chunk of the market. You're going to own carbon intensive industries, you're going to own low carbon intensive industries. But because you own a diversified portfolio, you can't actually remove yourself from climate risk, because climate change is a systemic risk. And the only way you can reduce systemic risk is by taking the perspective of a universal owner and saying, okay, in the short term, we could actually outperform potentially by going for high yield carbon intensive bonds, for example. But in the long run, that's not going to help our investment returns, and it's not going to help the people that we need to kind of deliver those returns to, for example, the people who actually receive the pension. So we need investors to take a longer term outlook. I think part of that is the current incentive structures that are in place in the investment industry and how suitable those are. But it's a great question. I would recommend checking out universal ownership theory. It kind of outlines it much more eloquently than I just have. So yeah, definitely check that out. But, great question.
A really good one from Andrew Russell here. In your view, what are the financing risks for fossil fuel energy companies who are seeking to transition to cleaner energy production?
Okay, yeah, no, this is a really good question. And I think there's a really interesting paper on this by this researcher called Helms. And essentially, you have at the moment, for example, incumbent electric utilities companies and incumbent fossil fuel companies that are looking to transition to low carbon. And historically, the returns and the risk on carbon intensive projects have been quite high. For example, upstream oil and gas, high returns, high risk. If you're then looking to transition to potentially lower risk, lower return projects on the renewable side, that can present some problems, because you're essentially using a cost of capital that reflects your high risk asset base to try and finance a lower risk project. So if you think about it, you're discounting potentially lower cash flows at a higher discount rate. And so if you're an incumbent company, that can make that transition harder. But if you're coming at this as a kind of a new entrant into the market where you don't have that legacy historical fossil fuel asset base. And so that's one of the research questions that I'm really interested in, is that if we begin to see the capital costs and the cost of capital rise for incumbent companies that own both renewables and fossil fuels, that could actually make investment in renewables harder, because you're going to be discounting those lower risk projects at potentially a higher rate. And so I think that's one of the interesting kind of really tough challenges for these companies which have historically have high return, high risk projects to transition to more lower risk and potentially lower return project. So that's one of the challenges that I see.
Okay. I'm worried that we've only got 10 minutes left of this Q&A before we move on, so I'm going to pick 2 or 3 more questions. So let's have a look at this one. So from Tom Jenkins, hi Christian, really informative and enjoyable talk. You mainly talk about the UK and a bit about the US, but I was wondering whether the policy options available to these nations are applicable to developing nations. For example, China, India, and African nations are likely to have a far greater impact on the climate than most developed nations, but are still less likely to achieve net zero by 2050. Interested to hear your thoughts.
No, absolutely fantastic question. And I think, one point to make is that often in emerging markets, capital markets are often less developed than in, for example, UK, Europe, and the US. And so what we often see in kind of emerging markets like India, for example, that you mentioned, China as well, is that state-owned banks and state-owned enterprises play a much larger role in these carbon-intensive industries. And that could mean that these policies that we're putting in place, where we rely on sort of market forces, may be less effective in emerging markets because the state is playing a much larger role in those industries. And so they may be, they're kind of incentivized to support those industries. And so this kind of cost of capital, climate risk question may be less effective there because you have incumbent industries which are either owned by the state or often financed by the state. But that doesn't mean to say green finance, sustainable finance does not have a role to play. It almost certainly does. And China, for example, is doing a lot of work in this space. It's just potentially you'll have more of kind of a top-down approach that is led with state-owned enterprises kind of integrating this themselves rather than sort of market-led forces, if you will. So that's one aspect of it. The other aspect of it is that you will have, we have these local economies, but capital flows are very much global. And in my old job, I worked in emerging market debt. So our job was essentially to finance these companies in emerging markets. And so there's definitely a big cross-border flow question, which is if you have in, for example, the UK and in Europe and the US, a huge proportion of investors integrating ESG and other climate-related risks into their investment process, what impact will that have on the emerging markets where those carbon-intensive industries are often located that rely on developed markets for those capital flows? So I think that's a really interesting, outstanding question, which is if you're a carbon-intensive company in an emerging market and you've historically used developed market investors to finance a big chunk of your operations, to what extent will the trend towards ESG and climate finance more broadly change that? So I think that's an interesting question to address as well. But I think green finance definitely has a role to play in those emerging market economies, but it may slightly be changed because of the larger role of state-owned enterprises.
Excellent. And one last question. As Dr. Jane Shen has put in the chat, we will field any unanswered questions Christian's way, so that when he has time, he might be kind enough to answer those as well. But the last question we'll finish on. So one here from Jonathan Boyle. Which are likely to be the most influential groups to publish ESG ratings, whereby the ESG performance of different companies can be compared using a clear taxonomy? The rating agencies or the investment management companies, for example?
That's a good question. So the taxonomy disclosures themselves will be done by the corporate, but that won't be done by the rating agencies or kind of the index providers. But I think what would be really powerful, and I think this goes to the second half of the presentation around indexes, is that if we have index providers such as MSCI, for example, and others, begin to integrate this information in how they construct indices, we can begin to break down this question about how passive investing, which track indices, can be used to harness the power of passive investing and actually support the low carbon transition rather than what we see at the moment, which is the opposite. So I think if index providers were kind of able to integrate those ratings, as you say, in that information taxonomy, that could be really powerful. And we've started to see that, for example, in the EU as part of their taxonomy and their sustainable finance plan. They've developed they're developing low carbon indices which will directly track the EU taxonomy. For example, reducing carbon emissions by 7% a year. So that could be really useful. I think credit rating agencies as well are definitely the gatekeepers here in terms of climate risk. But from a personal perspective and kind of reflecting on what we spoke about today, I think integrating these ESG ratings or taxonomy disclosures into how indexes are built could be really useful.
Excellent. Christian, thank you so much for your time today. We really appreciate it. I know you've been back to Exeter to help with the FAFM course numerous times since you graduated, and we very much appreciate your support. So thank you for today, and thank you everyone for the great questions as well.
No worries. Thank you so much for having me, and it's fantastic to see lots of interest in this area. And I can't recommend it enough as an area to get into. It's growing fast, it's really interesting, and it's really important. So if people want to discuss these issues further, as well as sort of careers and whatnot, do feel free to reach out, and I'm very happy to chat.
Thank you very much, Christian. Okay, so as I mentioned at the start of the webinar, we're now going to very shortly hear from some of our MSc Financial Analysis Fund Management alumni. First, I just wanted to show you a bit about what goes on in the alumni community, where you can see more of these webinars, listen to podcasts, so on and so forth. So I'm just going to share my screen now. Okay. Charlotte, can you just give me a thumbs up that that's working? Brilliant. Right, so so this is an Exeter alumni community event, and what is the Exeter alumni community? Because I know that not many of you would have been involved previously. This might be the first webinar for many of you. So especially during COVID-19, we've made a real effort to make sure that you don't have to look far to look at the latest research happening at the University of Exeter Business School. So we have podcasts that these cover a number of factors, a number of themes. There was a podcast very recently with our head of the finance department at the University of Exeter Business School, Professor Enrico Anali, all about the impact of COVID-19 and Brexit on financial markets. There is a mini series within those podcasts too, where you can hear from Exeter alumni all about what they've been doing since they left Exeter and embarking on their careers. We've also had a webinar from a friend of the Financial Analysis and Fund Management Programme, Chris Bailey, all about, again, financial markets in the year to date and outlook as we go forward as well in recovering from the pandemic. There are a number of alumni networks across the globe. When we get back to physical events, wherever you are on Earth, there are Exeter alumni near you who are holding social events and networking events. So please do get back in touch. And if you struggle to find an event near you, drop us an email at the Business School alumni team, and we'll be sure to post you to your nearest event. There's special interest groups. So this is the MSc Financial Analysis and Fund Management alumni network, but there's plenty more. There we have entrepreneurship alumni networks, and we have loads of special interest networks around sport as well. So again, the best place to find these is on our alumni website. I'll ask Beth if she can post a link into the chat now. You can see the latest events, the latest podcasts, webinars like this that are recorded. They're all up there. But that's enough from me. Oh, sorry, one final thing. If you are a recent graduate, particularly, this might be of interest to you, but all Exeter alumni are entitled to careers support for life. So that entails a large number of different resources that I couldn't possibly cover now. So all I can encourage you to do is go and look on the alumni web pages. If you're one of our MSc Financial Analysis and Fund Management alumni, especially within the last 3 years, you have a dedicated career consultant who you can contact, Jenny Phillips. I don't know if Jenny is on the call now, but if she is, I'll get her to put her email address in the chat. So feel free to get in contact with Jenny. We're here to support you, and especially in the tumultuous last 12 months or so, we know that career support is more important than ever. Finally, our global alumni ambassadors. So here at Exeter, we know that alumni are our best advocates of Exeter as an institution, but also we want to create a mutually beneficial alumni community where we're pooling everyone's expertise to really support each other wherever you are in the world, and give you access to lifelong learning, networking events, and career support. So today on the call, we've actually got a few of our alumni ambassadors for the MSc Financial Analysis and Fund Management course with us, and they're going to give you a short 2-minute talk about what they do. I'll just stop sharing my screen, and what they've been up to since they left Exeter. So without further ado, I'm going to ask first up if Nazeema Derbas could come on screen and give a little talk. Nazeema, are you there? Hi, Nazeema.
Hi, how are you?
Very well, thank you. Thank you for joining us. I'll hand over to you to just say a few words, and then I'll introduce our other FAFM alumni ambassadors as well.
Sure. Thank you for having me here. For anyone who'd like to know, my name is Nazeema Derbas. I'm from Lebanon and I've lived in Kuwait my whole life. Did my bachelor's here and then went to University of Exeter to do the MSc FAFM in 2017-2018. Since graduating, I took a few internships trying to figure out what I wanted to do with my career, which is something that really helps you grow, trying to figure out where you want to be. And using the skills and the knowledge I gained from my master's, actually, I settled into a career where I do a lot of financial analysis. My current title is Senior Associate Analyst, and I'm in the Research and Development Department in Holistic Development and Consulting. At the end of the day, it's a business consultation company, so I get to work with a lot of companies and help on projects where I have to analyze them, help with business plans, help with the consultation on creating models that they'll be able to use to make their work easier. I loved my time at Exeter because I gained so much more knowledge through the program on what financial analysis is and fund management. And we also got the training for the CFA, which really helped me prepare to take the exam. And it made me so much more adept to going to interviews. It increased my confidence. It added so much to my CV that I found it easier to engage with any employer and start with a team. And I felt like I wasn't starting on an entry level when I started my work. I felt like I was directly into associate officer mode. Like I knew what I was doing from the start. If you have any questions for me, I know time is short for the talking. So if you have any questions for me on what I do now and questions on classes from FAFM, I'm happy to answer.
Thank you, Nazeema. Nazeema's actually got a podcast on our alumni webpage that she recorded with Pam Sambiaton, who's our, you will know, our program coordinator. Highly recommend you go and listen to that. It's a really good listen.
That was a lot of fun, and plus I was on some of the brochures too with FAFM. I honestly love everything you do for us. Thank you for the quiz trivia night that you did, and it's always the program always managed to make things fun and take off the stress of the learning and putting time for class. So there's always a balance there, and it's such a nice community that I hope we'll get to see a lot more students down the line and have more networking sessions. So thank you for having me.
Thank you so much, Nazeema. Thanks for joining us. Next, I will introduce Sara Asif, please. I'll just check whether Sara's on the call. What we'll do is, well,
hello.
Sara, here we go. Sara, hello. I'll hand over to you. Thank you very much.
Can you see my video?
Yeah, all good.
All good. Okay, good. So, hi everyone. My name is Sara Asif. I am from Pakistan. And before just a little bit introduction, that before doing FAFM, I was working for USAID as a research grants coordinator. I also did my MBA from Pakistan, and then I went and did my MSc FAFM from University of Exeter. And after graduating, I came back to Pakistan and I started working again for the same project. I landed several other interviews after the project culminated. I landed several other interviews with the Best Way Cement and British Council. So FAFM program did help me in my employability skills, and I cannot say that I landed up in the exact career that I wanted to, but all the studies and everything I gained from my university experience helped me a lot professionally. Other than that, yes, I did get engaged and married. So I am now a housewife, and I'm helping my husband in his real estate business. And yeah, I'm also motivated actually as a housewife. What can I, how, creating a financial plan for housewives. I'm motivated towards that, and let's see how that goes. Why volunteer for FAFM? I think Pam contacted me several months ago. It has been a very difficult past year for everyone. And actually, I lost my father in June 2019. So while Pam contacted me, it was like a silver lining because Exeter has been a dream come true, which I owe to my father. And I think giving back to the community, I enjoyed as a thanks to all the professors, to all the people in Exeter who helped me to achieve my goals. So there was no other best way to just become a FAFM ambassador and promote what beautiful the program and the city itself is to other potential candidates and potential students. And yeah, so pretty much Exeter was wonderful, and I would encourage particularly the FAFM students to go to the Europe tour. Don't miss out on the Europe tour. It's quite exciting, and it's a memorable experience. Yeah, and to rest of the potential students, I guess, coming to Exeter, and especially to FAFM students, I would say that yes, University of Exeter is the right choice for you, and the university and city both have a lot of things to offer. And to be honest, that there was some things to do list. I had the things to do list which I made back in Exeter, but I could not complete it because Exeter has so much to explore, and not just the city, even the university, the campus itself. There's still some buildings which I haven't seen yet. So I'm sure all of you will enjoy your stay in Exeter. And one more thing I think that's important that helped me. I know as an international student, it's going to be difficult to settle down in the new environment. So just don't be afraid, and go seek help. The business school reception, they have a very good, they'll take care of everything. You just go there and tell your worries, and they'll reach out extraordinarily. They helped me, and I think they will be overwhelmed to help you guys as well. The well-being center, it's amazing. Don't feel shy, just go there, and they will take all the mental stress out of you. So yeah, just focus on your goals and have a good time.
Really great advice, Sara. Thank you so much for all the work you do for us as a FAFM alumni ambassador. We really appreciate it, and we'll have to get you back to Exeter sometime after the pandemic to show you.
I would definitely. I will surely love to come.
Brilliant. Thank you so much, Sara.
Thank you.
Next up, I'd like to invite Kirti to come and speak. I think she's on the call.
Yeah, hi Josh.
Hi there. Thank you very much for joining us. I'll let you speak now.
I'm more than happy to. This is the first time that I'm joining an alumni call or a meeting event. Yeah. So just to give a background about myself, my name is Kirti and I studied FAFM during the 2017-18 year. And currently I'm working in India. I am from India. I work as a senior associate with Grant Thornton, India. I work in the financial due diligence department. So my work is basically what my degree actually says. I do financial analysis. So FAFM has helped me get there. Talking about the university experience, I think since it's just a one-year course, you have a lot to explore in a very limited span of time. And I think Exeter has a lot to offer to us. Like, make the most of every opportunity that you get. I would just say that there is everybody to guide you. And like, you have PAM, you have your mentorship program. So you have a mentor assigned to you. So do benefit from all of those. The library, access to a lot of research papers and books. So I would just say make the most of it. And yeah, one thing which I didn't do at times, I would suggest everybody to do is please read your lecture notes before going to lectures. It really, really helps. And yeah, enjoy the experience. The city is it's a very small city, and the community that you form in your batch with your classmates, like FAFM has very limited students, so it's going to be a very tight, close community, and you're going to make friends for life from different countries. I don't think you'll get that opportunity anywhere else. So yeah, just enjoy the experience, but also study well, because you have CFA level 1 and 2 to clear. So just go for it.
Amazing. Thank you so much, Kirti. Really appreciate you coming onto the call today and giving the advice that you have. Brilliant. Finally, just wary of time, I'm going to pass over to Malek now, who I think should be on the call.
Yeah, can you hear me? Here I am.
Yeah, definitely. Thank you so much for joining us today, Malek. I'll hand over to you now.
That's great. Thank you very much, everyone here attending this. I just have a very short presentation to support my my short talk. I'm going to share my screen. Can you just making sure everyone can see it?
Yeah.
Don't worry, I will manage to stick to the initial timing. So yeah, just as a background, so I'm Malek Benlarbi. I graduated from the FAFM Masters in December 2019. And so I initially come from France, and I've always been interested in infrastructure investment and particularly green finance. And this I'm quite happy because this is the main topic of the 3-day session. So I think it was quite relevant for me to speak about my job and my experience. So I'm now an associate at Elgar Middleton in London. I joined them on January 2020, and so Elgar Middleton is an independent financial advisory boutique which is specializing in renewable energy transaction. We have offices in London and Sydney. So as a financial advisory boutique, we advise investors in renewable energy, developers for raising finance for their renewable energy projects. We are involved in projects across Europe and in various technology, which makes the job quite interesting. I just go quickly on a few case studies just to give you a bit an overview of what we do. So here I've presented 2 projects I've been working on. So one is a debt financing for a portfolio of solar PV in Ireland. I've just highlighted some of the high-level main steps when we do this kind of mandate. And the other one is the sale of an anaerobic digestion plant. So a very interesting technology, not as mainstream as solar. And this is also what is very interesting in this kind of job. I just highlighted here at the bottom of the slide just a few main aspects of my day-to-day of my daily job and my daily activity. So as you can see, you are dealing with various mandates that are like in different geographies, different technologies. So you really have to be able to adapt yourself and to change your state of mind. Like when you're working on an Irish project for a solar Irish project, and then you have to go back to a greenfield, anaerobic digestion project. So this is really tight, but this is why it's exciting about this job. You are in direct contact with the client, so you have to be very professional, and you have to access to all the client's demands. So it makes this kind of job very interesting and challenging. And some project may have very very tight time constraint that you have to follow. And so this is again more challenge to the job. And also it's something that is important for me, and I guess something important for you if you are here today. You contribute to the development of renewable energy, and this is a very valuable asset for this job. Then just to conclude on my FAFM experience, so I graduated in 2019, so I left FAFM not that long ago. How the FAFM helped me in landing my job is like, it's definitely a game changer. So I've just highlighted here a few examples of what it brought me. So of course you have the CFA exam. So I passed the first 2 levels. I'm still expecting to take the 3rd level, but it keeps being postponed. Hopefully this year it's going to be the good one. Then there is also the CFA challenge. So I personally took part to the CFA research challenge, but there is also the CFA ethics challenge. So all those challenges that are brought to you by the CFA or even other entities during the course of the master's is really important. As an example, it's really like it really attracts the curiosity of the recruiters, and so they are going to choose your profile, and they are going to spend a lot of time talking about this. And if you are interested, if they are going to be curious about that, and if you are interesting, then it's going to be really really important for the recruiters. So this is something important because it really makes you at ease during the interview, because it's a point that is often raise curiosity of the recruiters. Then, of course, the content of the course was quite particularly helpful in what I'm doing. I'm evaluating a project, but at the end, it's cash flow valuation. So it's something that has been largely covered by the materials of the masters, and also the quite good quality of the masters and the good image of the University of Exeter in the industry is something that is really appreciated by the recruiters again. Also, like in the same hand of the content of the course, you have some very insightful lecturers and speakers that comes during the program, and so that's really brings something to this masters. And as it has already been covered, you meet new people from around the world, and it's not as you could do in any other masters, because often FAFM is really much a family. The cohort are smaller. You start at a different time of the year. You usually start, I don't know if it's still the case, but you usually start a few weeks before all the university starts. So you are really sharing you are really sharing experience with the people in your cohort, and so you really stay in touch with them. And it's really important because it allows you to network with people that you are almost sure are going to work in the same industry. And there is it's highly likely that you will end up meeting these people in your professional life again. And so this is something really important to have. And it brings us to the importance of the alumni and of the networking here. It's like, so just as an example, I secured my internship just after the course that was in the exact same field I'm working now. And so it's definitely an internship that helped me securing my job. And I entirely secured them thanks to the FAFM alumni, because 2 of the people working in the company were from the FAFM masters. And so this, and I'm not an exception. It has been the case for like many other people that secured either an internship or a job directly after the program, thanks to the alumni. You can also benefit from a very valuable career advice from the Career Center. I've just listed a few examples. I don't know if it's still in place, but that was really helpful. So like you have some interview training, you can get a review of your CV. And so you should really, if you have the opportunity, make the most of it. it can bring nothing, but usually it will bring a lot, and it will just make you more confident for the interview and when you prepare a CV or a cover letter. And also, of course, the alumni network, as I said already, I personally benefited from a mentoring scheme. So I had a mentor during the year, during the FAFM year, which is working at BlackRock, and I'm still in contact with him every few months. He's working in London. I shared a drink with him when we were still authorized to do so, and so yeah, this is something like I've just like one person in my network that comes from the university, and which I've been in touch thanks to the alumni and the career center. So this is something you should also really have a good look at it. And so this is why I'm here today. It's like this is the way you make the alumni more interactive, more active, thanks to this kind of events. So I would like to really thank all the people who organized this event today and are going to organize the future event, because this is a very important aspect of the alumni network, is for it to be very active, and so it really contributes to the positive image of the degree and of the university in the industry. And so yeah, this is something I really encourage you, is like taking part and being involved in this kind of event, and make the alumni network active. So yeah, that's it for me. Thank you very much. And if you want to contact me for any career advice or any questions on my job or anything else that could be interesting about the masters, about the university, I think the best way to contact me is through LinkedIn. So yeah, feel free to reach out to me here. And I think the link is also in the FAFM ambassador page in the career, in the alumni or the business school website. So yeah, feel free to reach out.